Hi guys, welcome to the Explorer. For the last some days, we are constantly seeing the news regarding the banking failure in USA. So today we will know in depth about that. It is basically fall of two large American banks. One is Silicon Valley Bank, situated in California. Other is Signature Bank in New York. The failure of these banks is second largest banking failure after 2008 in USA, which led to the global 2008 recession. So let's understand how SVB works. There are basically three entities: SVB, VC, venture capitalist, and PE, private equity firms, and the startups. SVB gives loan to VC and PEs, and VC and PEs invest it in startups. Although SVB can also directly invest in startups. Now, after getting the loan, startups have a lot of money. So, they deposited most of their money into SVB because SVB is a very startup friendly bank. Now, before previous year, COVID started and lockdown was imposed. People were at home doing day long scrolling, YouTube, Instagram, seeing Netflix, Prime, Hotstar videos. So tech products were in demand. Tech startups started growing rapidly. Now, startups needed loans to grow and scale. A lot of money at that COVID time was also pumped into the system, and interest rates of loans were very low. So banks gave loan to startups at very low interest rates. Now startups will definitely deposit the money. So where they will deposit? They will deposit it in SVB bank. Now it has been observed that the deposit in SVB increased by more than 3 times in 2021 from 2019. So what the SVB bank will do? Of course, they will invest it in somewhere. So they have invested majority of their deposit in HTM. What is HTM? HTM is held to maturity bonds. It means that they have invested the money for a long period of time, sometimes like 5 to 10 years, and before its maturity, they can't withdraw the money. Otherwise, they have to pay heavy penalty. Now, after COVID, as a lot of money was pumped into the system, inflation increased. So, now to control inflation, US government increased interest rates. Now, as interest rate on loans increased, it has an effect on the bond price. Bond price generally decreases on increasing interest rate. Also, as the loan interest increased, startups will no longer take loans, and all startups rush towards the bank for their money to withdraw their deposit to carry out their day-to-day operational expenses. But bank has not that much liquidity and its money was at loss, which was invested in bonds. Bank sold some of its bonds at very low, at very heavy loss. Also, it doesn't have enough money in liquidity form to pay the startups, leading to bank run. Also, the SVB stock price decreased or fall by more than 60% in one day. So what next? FDIC created the Deposit Insurance National Bank of Santa Clara to allow depositors access to their insured deposits and time to open accounts at other insured institutions. all of the assets and deposits of SVB were taken away by FDIC, and the depositors will need to collect their insurance amount from SVB. That's all for now. If you like this video, please subscribe my channel and hit the bell icon. Thank you again.